Where do you put $10,000 in 2026? Not $100. Not, I just started investing and bought half a share of something with a logo I liked. Not, my cousin said this coin is going to the moon and he was wearing sunglasses indoors, so he seemed credible. No, $10,000. This is the number where money starts asking you questions back. Because at $10,000, your choices begin to matter. Your mistakes get louder, your discipline gets tested, and your portfolio starts acting like a mirror. It reflects whether you are building wealth or just collecting financial hobbies. And 2026 is not a boring backdrop for this decision. Inflation in the U.S. was running 2.4% year over year in February 2026. Core CPI was 2.5%, and the Federal Reserve in March 2026 kept the federal funds target range at 3.5 to 3.75%. At the same time, Treasury data on March 26, 2026 showed short-term Treasury yields still hovering around the high 3% area. In plain English, cash is no longer trash, but lazy cash is still lazy. So this video is for the person who is past beginner mode. You already know you should probably invest. You already know diversification is not a skincare routine. Now you want to know, how does an intermediate investor deploy $10,000 intelligently in 2026? That is what this video is about, not fantasy. Not flexing, not turning your portfolio into a Vegas bachelor party. A real strategy, a durable strategy, a strategy with a trail you can follow. Why $10,000 is different. $10,000 is an awkwardly beautiful amount of money. It is too much to just throw randomly at 5 trending tickers and call it strategy, but it is not so much that you can hide bad thinking under complexity. You cannot build a family office. You do not need a private banker named Sebastian. You are not diversifying across olive groves in Spain, lithium miners in Chile, and a vintage watch fund run by 3 men named Hugo. You need something better. You need structure. The SEC's core guidance has not changed. Investing begins with asset allocation and diversification, meaning you spread money across categories like stocks, bonds, and cash based on time horizon and risk tolerance. Diversification does not eliminate loss, but it can reduce the odds of one bad bet wrecking the whole ship. That sounds boring until you realize boring is often just another word for repeatable, and repeatable is beautiful. Because the person who compounds for 10 years usually beats the person who improvises for 10 months. The 2026 backdrop. Before we decide where to put the money, we need to understand the battlefield. Here's the 2026 investing setup in normal human language. Inflation is not raging the way it did in the earlier post-pandemic years, but it is not dead either. CPI in February 2026 was 2.4%, and core inflation was 2.5%. The Fed is not handing out free money punch bowls. In March 2026, it held rates at 3.5 to 3.75%. Short-term treasuries are still paying yields that force investors to take safe assets seriously again. Treasuries' published rates for March 26, 2026 showed 3-month bills at 3.73%, 6-month bills at 3.77%, and 1-year at 3.83%. Series I savings bonds issued from November 2025 through April 2026 carry a 4.03% composite rate, including a 0.90% fixed rate for that issue window. That means 2026 is not a year for one-dimensional thinking. This is not 2021, where people acted like risk management was a personal insult. This is a year where a serious investor can say, yes, I want growth, but I also respect yield, and I would like my capital to survive contact with reality. Beautiful, because when reality returns to markets, adults can make money again. The 5-bucket strategy. If I had to give an intermediate investor one framework for where to put $10,000 in 2026, it would be this. Bucket 1, tax-advantaged accounts first. Bucket 2, core equity exposure. Bucket 3, defensive yield. Bucket 4, strategic optionality. Bucket 5, controlled aggression. That's the whole game. Let's walk through it. Bucket 1, tax-advantaged accounts first. Before you chase returns, ask a more intelligent question. Where does this dollar get treated best by the tax code? Because keeping more of your gains is a return. For 2026, the IRS says the ORKI elective deferral limit is $24,500 and the IRA contribution limit is $7,500. If you're HSA eligible, the 2026 HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. So if your $10,000 is sitting in taxable cash while you ignore tax-advantaged room, that's like winning a race and then paying a toll to celebrate. Intermediate investing is not just choosing assets, it's choosing wrappers. Bucket 2, core equity exposure. This is the engine, the heart, the giant boring machine that wealthy people quietly love while loud people mock it on podcasts. Index funds and ETFs remain the cleanest core exposure for most investors because they allow you to own a broad slice of the market rather than pretending you were clairvoyant on 7 companies before breakfast. Investor.gov defines index funds as funds that seek to track a market index and ETFs as pooled investment vehicles that can hold stocks, bonds, and other assets. For an intermediate investor in 2026, the core equity bucket usually means some mix of U.S. broad market index exposure, large cap exposure, international developed and/or total international exposure, maybe a modest small cap value tilt if you actually understand why you own it. This is not where you get cute. This is where you get paid for patience. Your core equity sleeve should do one job: capture global economic growth without requiring daily emotional performances from you. If your portfolio only goes up when you're stressed, that's not a strategy. That's a hostage situation. Bucket 3, defensive yield. Now we get to the part that 2021 investors would have laughed at and 2026 investors should respect: defensive yield. This is where part of your $10,000 goes into instruments that are not trying to be heroes, they're trying to be reliable. Examples include treasury bills, short-duration treasury ETFs, money market funds, I-bonds within their rules and purchase caps. Why does this matter? Because in a market where policy rates remain elevated relative to the ultra-cheap money era, safe assets actually pay something again. Treasury and Treasury Direct data show yields in the high 3% range for short maturities and a 4.03% current I-bond composite rate for the applicable issue window. At the same time, that changes behavior. Now, cash-like assets can serve 3 roles at once: stability, income, and dry powder. Dry powder is beautiful. Dry powder is confidence in liquid form. Dry powder says, if markets panic, I don't have to panic with them. I brought snacks. Intermediate investors stop seeing every uninvested dollar as failure. Sometimes a reserve position is not hesitation, it's optionality. 4. Strategic optionality. This bucket is for the investor who wants room to maneuver. Not because they're indecisive, because they're intelligent enough to know the future doesn't send calendars. Strategic optionality means allocating some money to opportunities you may want to add to later. That could mean a small reserve for equity drawdowns, a future rebalance into bonds if yields become more attractive, cash for a tax-advantaged contribution later in the year, or simply avoiding the mistake of being 100% committed on day one. This is the maturity stage of investing. Beginners say, deploy everything immediately or you're not serious. Intermediate investors say, I have a plan, but I also respect uncertainty. That's a different species of confidence. 5. Controlled aggression. Now, yes, I know, you want spice. You want upside. You want one section of the portfolio that makes you feel like you're not just building wealth, but starring in it. Fine, but we do it with a muzzle on. Controlled aggression means a small, predefined allocation to higher volatility ideas, sector ETFs, individual stocks you've truly researched, a thematic sleeve, maybe even alternative exposures you understand well enough to defend in writing. Notice what I didn't say. I didn't say take $10,000 and scatter it across speculative assets like you're blessing the internet. Now, controlled aggression is where you express conviction without giving conviction permission to destroy you. A good
rule for many intermediate investors is simple. Let your core make you wealthy. Let your satellite ideas try to outperform. Never reverse those jobs. If your fund sleeve is larger than your retirement sleeve, your portfolio is being run by your inner 14-year-old. He should not have access to the family vault. 3 sample ways to allocate the $10,000. Now, let us make this practical. These are not the only ways to do it. They are thoughtful templates. Option A, the balanced intermediate investor. For the person who wants growth, some defense, and a sane nervous system. $5,000 in broad U.S. and international index funds. $2,000 in short-term treasuries or money market/T-bill ladder. $1,500 into Roth IRA or traditional IRA if eligible and not already maxed. $1,000 in HSA if eligible. $500 in controlled aggression, one researched idea or sector tilt. Why this works? Because it respects the SEC's diversification principle, keeps a growth engine, and still honors the fact that 2026 offers non-trivial yields on defensive assets. Option B, the tax efficiency maximalist. For the person who loves optimization almost as much as oxygen. $7,500 into IRA space if eligible and available in 2026. $2,500 toward HSA or 401k adjacent contribution strategy/cash reserve to support payroll deferrals. Why this works? Because taxes are friction, and friction compounds too. The 2026 contribution limits make tax shelters one of the highest IQ destinations for serious long-term investors. Option C, the opportunistic intermediate investor. For the person who already has some retirement structure and wants flexibility. $4,500 in core index funds, $3,000 in treasuries/short-duration safety bucket, $1,500 in international or factor tilt, $1,000 held as deployable dry powder, $0 to $500 in high-conviction speculation, capped hard. Why this works? Because it gives you growth, yield, and room to act when markets hand you better prices. What intermediate investors get wrong? Now, let us talk about the traps. Because once people graduate from beginner status, they become vulnerable to a more sophisticated stupidity. Not ignorance, overconfidence with vocabulary. Here are the big mistakes. Mistake 1, confusing complexity with skill. A portfolio with 19 positions is not automatically smarter than one with 4. Sometimes complexity is just fear wearing a spreadsheet. Mistake 2, ignoring taxes. A mediocre investment in a superior tax wrapper can beat a better investment in a sloppy taxable setup over time. IRS contribution limits for 2026 make this especially relevant. Mistake 3, going all risk or all safety. In 2026, the environment rewards balance more than ideology. You can get meaningful yield in defensive assets while still pursuing long-run equity growth. Mistake 4. Investing with no purpose. Every dollar should know its assignment. Emergency reserve? Retirement? 5-year opportunity fund? Aggressive alpha sleeve? If all your money is in one pile, your brain will eventually mismanage it. Mistake 5. Buying stories instead of systems. A good story can sell a bad asset. A good system can survive a bad headline. And in markets, survival is underrated because it is not glamorous. But survival compounds. Drama usually invoices. The deeper principle. Here is the deeper rabbit hole. Investing is not mainly about picking assets. It's about managing future versions of yourself. The frightened version, the greedy version, the impatient version, this YouTuber said uranium, Frontier AI, 3 biotech names, and a Peruvian copper miner version. A portfolio is a behavioral device. That is why the best allocation for your $10,000 in 2026 is not the one that looks smartest in a screenshot. It's the one you can hold, add to, and rebalance without your personality setting the house on fire. This is why diversification still matters. This is why broad funds still matter. This is why cash-flowing defensive assets matter again. This is why tax sheltering matters. None of that is exciting on a thumbnail, but a lot of rich outcomes begin with unexciting discipline. So, where should you put $10,000 in 2026? Here's the clean answer. Capture tax advantages first where possible. Build a core with broad equity exposure. Use treasuries or similar instruments for defensive yield and flexibility. Keep some optionality. Limit speculation to a leash, not a lifestyle. Because $10,000 is not just money. It's a test. A test of whether you want to look like an investor or become one. And the people who win long-term are usually not the loudest. They're the ones who build the machine, feed the machine, and let time do what time has always done to disciplined capital. Multiply it.